Okay, you're all welcome to today's module. This is Earth Business Analytics and Research Consulting, and we're running a course on Excel for Career Upliftment. And this is Module 3, Financial Management or Financial Analysis. And this is Day 7. You're all welcome. In every aspect of our life, we have either mentioned or touched finances. And so whichever industry you come from, financial analysis or financial management is very important, even if you are a housewife. In Module 1, we saw how to build a budget template, or we saw how to use a built budget template to track your monthly income and expenses, even as a student or as a parent. So today we're going to dive a bit deeper into financial analysis. So you're all welcome. I am Wana Edwin, and I'll be taking you in financial management and financial analysis. So as a data analyst, it is our duty to bring to you this insight. So let's ride on. Right, so we're going to look at budget elaboration. We're going to look at budget elaboration and direct and indirect costs. For those of you who have been getting these words, I don't know what they mean. Cash flow and cash transactions. You always hear financial analysts, accountants talking about cash flow, statement of cash flow, income statement, balance sheet. I don't know some of those things. Well, we'll look at them, but maybe for your business, you don't really need to go into all those details. Ratio analysis, but we'll see a few of them. Bank reconciliation, ledger, profit and loss account, and financial reports. Very important. Especially for those of us in the humanitarian sector, financial reports are very important, and all of us into business. So, budget elaboration and elements of a budget. So, what is a budget? A budget is a financial plan that estimates income and expenses over a period. So, income is money that comes in. It might not be physical cash, okay? If you give out a product to somebody and the person promises to pay you, that's account receivable, right? So it means that you can record it as income, although you don't have physical cash. So when you have a financial plan that is estimating how much will come in, for example, when you're writing a business plan, you do a projection of how much that business will give you, right? So when you have a plan that estimates how much money will come in and how much money will go out over a period of time, maybe for 1 year, for 6 months, for 3 years, that is what we call a budget. And a budget helps you in planning. It helps you to be able to allocate resources properly, because if you do not plan, you may end up using all your money to buy one thing. Meanwhile, you have other things to buy, okay? So it helps you to control, and of course, it helps in monitoring your financial resources, as we have said, to ensure that you don't overuse some resources in particular areas, all right? Okay. So, importance of budgeting. It guides financial decision making, because if you want to start a business today, you've written your business plan and your budget is say $5 million. So this is going to help you to actually ask yourself, if you are able to start this business, will you start the business or not? Okay, and there are also ways to raise funds, right? You can raise funds from your personal savings, from loans, from grants and all that. It helps avoid overspending because you have a guide. Budgeting encourages saving because you see how far you've gone, you see how much you spent. It aligns income with goals and it tracks progress over time. Those of you who are into project management, every budget line, every activity you carry out has a budget line. And so budgeting is very, very important. So how to prepare a budget? You first of all define your time period. Okay. This project I want to carry out, this business I want to start, how long will it take me to start this business? Or how long will it take me to execute this project? How long will it take for me to, for those of you who are into projects, how long will it take for you to execute the project? Is it going to be a project for 1 year? That's why we always talk about the holy trinity of project management, which is time, scope, and budget, right? So the time is very important. When you identify the period, maybe you want to start your own business in the next 3 months. So how are you going to be able to uh you plan how you're going to identify the resources that will give you income? So if you want to start a business in the next 3 months, right? What kind of business do you want to start? Do you want to do electronics? So what are the various things in the electronics that are going to give you income? Are they TV sets, smartphones? You have to identify all that. Okay, that can be one thing that will give you income. Now, how maybe you have on savings, maybe you save some money that you want to start. Maybe you can take a loan from the bank. You have reached the stage where you are eligible for a loan, or maybe from friends, from family. So you identify all the sources of income. Then you list and categorize the expenses. All right. So what do I need? I need to buy, and maybe you need to rent a place, or first of all, maybe you need to register a business so that you are a legal entity, which you have to pay. Maybe you need to rent a place where your location, an office or a shop. All right. Maybe you have to do purchases. Maybe you have to travel to another town to do purchases. All right. So you have to list all that. If it's a project management, you have to look at your project and list all the activities that you have to carry out in that project. And then you categorize them into different budget lines. All right. Then you estimate the various amounts. How much will this cost? How much will this cost? You're just estimating because in budget, you're not doing the thing already. You're still estimating. And then you ensure that the expenses don't exceed income, because if the expenses exceed your income, then you're going in for a loss, right? Then you document and review. Most often, we think all these things and we never write. We have good ideas, but we never write them down. So documenting is very, very important. Okay? Very, very important. All right. So the income is the expected earnings, as I mentioned above. If you are in an electronics, you want to start up an electronic shop, maybe you need to get TV sets, smartphones, distributors, and all the stuff that will bring you money. Then you have what we call fixed expense. The fixed expense are things that they are just there and they are consuming money, like your rent. All right. Your rent is a fixed expense because the rent is there and it doesn't change unless you have your contract put. Maybe the landlord ends and they want to review the terms of contract. But it's something that is there and it's predictable. You know how much rent you're going to pay. Maybe you know how much transportation you're going to pay to go get your goods, right? Then we have variable expenses. So things that fluctuate monthly. Maybe you go to buy a TV set and today this particular brand is this price, and then you go to the next month and due to maybe inflation or deflation, the price has either gone up or gone down. So those are variable expenses, those things that change over time, right? Like food, uh, household appliances, goods, and even services. Some services, right? Like those of us into data analysis during the period of June, the price of these services may reduce because there are many analysts and there's competition, right? But maybe by October, when many students have done their defense, maybe the price will go up because we have very few clients, right? Now you have what we call the contingency or reserve. This is money that you keep for emergency. You need to have emergency savings. And of course, you have your balance, which is income minus total expenses. All of us know that one. So this is an example of a budget template, which you're going to see in Excel. So you have the revenue, which can come from your sales and sales of your goods, or maybe your services, like those of us who do data analysis might come from you carrying out data analysis. Now the operating cost, if you have an office space or a shop, you have to rent it, right? Utilities, you have to pay electricity, you have to pay for water bills. Then maybe you have to pay your own self. If you don't have a salesperson, you have to pay your own self, right? Those are operating expenses. Then you have to do some marketing. Maybe you have to run some ads online. You have to print some flyers. Those are marketing expenses. Then you have some things like one-time expense that you can do, like buying of equipment. Maybe you stand and you want to start your shop and you want to buy maybe a refrigerator. You want to buy maybe an AC, an air conditioner. Those are one-time expense that you can incur. All right. Maybe with time, maybe our AC can get bad and you want to repair it. Those are things that they don't happen all the time, right? They are not revenue, they are expenses, but they are a one-time expense and things that you don't preview. Your fridge doesn't tell you that you'll get back tomorrow, right? Then taxes, you know how much you pay your taxes. Sometimes the taxes can increase based on government regulations, right? Then you have contingency fund, like emergency, okay? And then you have your business profit, which of course, you know how to get this one. You must subtract your expenses from your income. This is just for the basics, right? Because you have things like net profit, things like that you need to calculate. So for budget tips, you have to track your spending, be realistic, save regularly, and adjust as needed. Most of us, we are not realistic. When money comes in, we have some revenue for say 20,000, we just go and take ourselves on a treat, not knowing that it is very important to track. You're going for a treat because you saw an appliance and you had 20,000. Do you know how much maybe you're owing your landlord? Do you know how much you need to keep for unforeseen circumstances if those equipment go bad? Depreciation and things like that. So it's very important. Most of us on our businesses without even thinking of depreciation. We buy machines, we don't put a particular amount of money somewhere in case that machine gets bad, we can use it to repair, you know, things like that. We don't also value the machine every year. So there's a lot in costing and finances that we don't know and we don't do. Because big companies, they value all the equipment. Every year they do depreciation analysis and they know how much value that machine actually has at a particular time. And if they want to sell it out, they know exactly how much they can start bidding the price. All right, so let's move to the next thing, cost classification. So this is very important. What is cost classification? The process of categorizing costs based on their nature and behavior. You don't just put, you want to go to the market for those who are housewives, you just take your list and write down things. You're supposed to classify them. There's some things that you may not want to buy that particular moment based on how much finances you have. Helps in budgeting, pricing, and effective resource allocation. So this diagram helps you to see how some analysis can be done. Expense analysis. Consumption here takes the highest. New computers is for maybe a business, internet bill, furniture, donations, CD writer, construction, mobile charges, advertisement, and so on. So you have to categorize. If you're into business, you need to categorize your costs. Cost for rent, cost for marketing, cost for salary. You need to break that down so that that's what we call budget line. Okay. If you want to pay your staff, you're going to the budget line for salaries. If you want to pay your rent, you're going to the budget line for maybe fixed costs, all right, and things like that. So it's very important to always plan. You can practice this even in your house. There should be a budget line for donations. There should be a budget line for household consumption. If you want to, somebody to visit you, like in most African countries, people visit us, and maybe when they're going back, you need to give them transportation. That should come from your budget line of donations. If you never take money, maybe you have care for health, and then you give someone to pay transport. I know sometimes it's very difficult for us as Africans, but it's very important to stay disciplined. All right. So importance of cost classification, it enables accurate budgeting, it assists with resource tracking, improves financial reporting, informs project pricing and accountability. All right. Direct costs. So we've seen direct costs. We're going to see indirect costs, directly attributable to a specific project or activity. For example, fee worker salaries is directly attributed to a specific activity, fee work. All right, materials and supplies for a specific activity. For example, you're running a project and you want to do you have to organize a workshop. There's a budget line for that workshop, and everything that you're doing, you're buying materials, you're making roll-ups, you're renting the hall, everything that you do is specific to that particular workshop that you want to carry out. That is what we call the direct costs, all right? Transportation for project trips and all that. Direct cost for you starting up a business. Maybe you want to start up a service industry or into maybe catering. You want to start a business where you do catering services. The direct cost is direct money that you have to use to purchase all the equipment you need, to transport yourself to where you need to get them, to rent your shop. Those are that's direct cost. Okay. Okay. Because so is excuse me. So indirect cost, my so comparing direct and indirect costs. But what is indirect cost? First of all, just give me a minute. All right, so we're here. So indirect cost is shared across several activities, not directly assignable. Okay. For example, you want to carry out, like I give an example of you carry out a workshop, right? Maybe in your organization, you want to carry out a workshop. And there's a budget line for that workshop. That's direct cost. All what you do for that workshop is direct cost. But then maybe somebody has to assist in that direct cost, and that person is a human resource officer who is not directly linked to that particular project. He's there, he helps in all projects. And a particular percentage of money is saved every month that culminates to paying the human resource officer. So that's money, or to pay the rent, because every project, if you're running a humanitarian uh, organization, every project you contribute to pay your rent, all right? If you have a shop, every item you sell in that shop should contribute to paying your rent. If you're running a service industry like ethics analytics, every data you analyze, whether you're analyzing student, for a researcher, for a company, you're using SPSS or whatever, everything you do, there should be a small cost that goes in to support the rent or the taxes paid by the company. So that is indirect cost. It's not really linked to that particular activity, but it goes to help the whole organization. I'll give an example of the human resource manager, the office rent, internet and electricity. These ones are not really linked to a particular project, but all projects contribute towards that. All things in your shop, what you're using to subscribe for internet connection in your shop or in your service company should be as a result of the money that you receive from the various services that you render. So internet is not linked to a particular service. I'm not going to say that I will only analyze data for students and use it for internet connection. So what happens the month that I don't have students to analyze the data, I rather have companies to work with them. Does it mean I'm not having any connection? No. So all projects or all services I render have to contribute a quota to internet connection. So internet subscription is an indirect cost. I think it's really clear, right? Salaries of admin staff, like I mentioned for the human resource officer, those are examples of indirect cost. So comparing direct and indirect cost, direct cost is specific activity, while indirect costs can be multiple. You can share it among multiple activities, as we've seen. Training, for example, you can have training materials like we mentioned, but now you can have office rent, electricity. Budget impact, a project specific line. Yeah, every budget line will be shown. But then indirect cost goes under overhead support cost lines. So if you're writing a project, of course, there should be a budget line for overhead or support cost line. It is from there that you're able to to allocate money for indirect costs. Although you can still save a little amount of money from your workshop, your activities to be able to cover for this indirect cost, because it may not be enough. Sorry, to also cover for overhead, because it may not be enough for you to do all the indirect, to be able to handle all your indirect costs. Okay. All right. So the next thing we're going to see is cash flow management. What is cash flow? Very interesting. Cash flow refers to the movement of money into and out of an organization. That's simple, right? From the word flow and the diagram you can see on the board. Cash flow, money received, for example, from sales of your products, from sales, from after you render your services, from grants, right? Then cash outflow. So you have cash inflow, you have cash outflow. So cash outflow now can be money that you spend, maybe on salaries, on purchase of equipment, on fuel, on transportation, etc. right? So you have cash inflow and you have cash outflow. So why is cash flow important? It ensures enough funds for daily operation. When funds come in, you can easily use them for daily operations, right? Then prevents late payments and penalties, enhances financial stability, aids in budgeting and financial planning. Very, very important. That's why it's important for you to always track your cash. Cash here is money at hand, okay? So when you hear cash in finance, know that it's money that you have in your office. So you can help it to sort out emergencies, right? If you don't have money in your hand or your bank account and you run into an emergency, what will you do? So you need a constant flow of cash in and out. It's very important for the survival of a business. When we get to financial ratios, you see we calculate current ratio and all that. You see how this plays in helping a business to thrive, and you see what investors use to be able to determine if they should invest in a particular business or not. They use all those ratios, current ratio, they use debt to equity ratio, they use all of those to be able to determine if they should invest in a particular business or not. All right, so petty cash, small amounts of cash used for minor expenses in daily operations. Always the accountants talking about petty cash. So you can have office supplies, maybe pens, folders, minor repairs. You always have some money, maybe 5% of something that is kept in the office for some of these things, managed with a petty cash lock and regular reconciliation. Always you go and reconcile. Maybe you are in a big company where we have many departments. The head of the department has to have some petty cash that they manage, maybe to do some repairs. They always go maybe at the end of the week to reconcile with the accountant, or at the end of the month to reconcile with the accountant. Okay, I took $100. I'll spend this amount to repair this. I'll spend this amount for transportation of the staff who has to go to town and do some work. When we're working at the Cameroon Baptist Convention Health Services, we have some things like that. When we go on mission and come back, we always need to reconcile with the central accountant. It's very, very important. All right. Cash, ground cash, that's the main cash or bank transactions. Larger transactions usually managed via bank accounts or cash registers. Sometimes salaries of staff are paid via bank transfer, right? Good. Example salaries, okay, I just mentioned that. Major purchases, contract payments, like you hear a company advertising for doing a bidding. Suppliers have to do bidding, and then some company will choose a supplier that has the lowest bid. That means what they can pay, and then they'll pay the money directly into that supplier's account. So those are major transactions in terms of a few hundred thousands to millions, okay? Tracked through accounting software or cash books. So banks can tell us more about this and big enterprises, all right? All right, so simple cash flow table. So you have the grants, maybe you receive grants if you are working in a humanitarian organization of maybe say $500,000, and then you have to pay office rents of 150,000. Then you see the balance, right? It's just subtraction, okay? If you're using Excel, just put a formula here and it subtracts. Petty cash disbursed, 50,000, maybe workshop revenue, you know, maybe the granting organization gives you more money, because at times they don't give money to organization all at once. They can give you 50% after maybe 1 year, or when you go halfway into the project, they can add it to 25%, and just like that. It's very important. So let's look at a case study. The NGO has just received a grant of 500,000, let's just say dollars, since that is more comparable to Central Africa. You need to manage the grant to pay for upcoming expenses, including office rent, petty cash, and do some workshop, maybe some capacity building workshops. So activity, using the provided case to create a basic cash flow for the next 2 weeks, showing how the grant will be managed. So this is your assignment. For those who are following this from the class, you have to do the assignment and then share in the group for us to check. Okay? So bank reconciliation.